Growth is really good. More premiums, more customers, more market share. That's what every insurance company really wants. Yeah. But here's the uncomfortable truth about it. Growth can actually destroy your ROE. And many companies don't really realize this until it's too late. Welcome everyone. This is Diego speaking here from the clinic, your go-to channel for everything FP&A, insurance accounting, finance, and everything to the strategic side of finance related here. In this new series, we're going deep into how capital works in insurance, and today we're starting with a big one, which is why growth doesn't always create value, okay? So to kick things off, we're going to talk about the illusion of growth. On the surface, growth looks great, always like this. Premiums go up, revenue increases, and the business looks like it's expanding, which is great. And internally, growth is going to be celebrated, as always. But in insurance, growth comes with something that most people underestimate, which is risk. And risk requires capital. This is key. Risk requires capital. So every time you grow premiums, you're not just increasing revenue. You're increasing the amount of capital the business needs to hold. Okay? Let's talk about the capital mechanics a little bit. Let's break this down simply. At least I'll try. So, in insurance, capital is there to absorb risk. Okay? So, if you think of it, more capital, more policies equals more exposure, and more exposure equals to more capital required. Now, here is where it gets interesting. If you grow fast, but your pricing is not strong enough, or your risk selection is weak, you're increasing capital faster than you're increasing returns. Then that puts pressure on ROE, because ROE is not about growth, but it is about the return relative to capital. Does that make sense? So now let's talk about where the things go wrong. Let's address this. So this is where many companies fall into the trap. They chase growth targets. They push for volume. They expand into new segments. But they don't fully adjust for this. They don't fully adjust to risk, quality, to pricing adequacy, and capital intensity. What happens? Premiums grow, which is the expected, right? But in the other side, we're going to have loss ratios deterioration, volatility increasing, as well as capital requirements going up. And all of a sudden, ROE starts to go down. Even though the business is now growing, things are not growing sustainably. Okay, so that doesn't make sense to have a growth that way, from an ROE perspective at least. So now let's address the strategic perspective here. This is why insurance growth needs to be disciplined. Not all growth is good growth. That's a reality. And growth, like good growth, is actually growth that is properly priced, 1. Growth that is capital efficient, 2. And growth that improves risk-adjusted return, 3. 3 factors, keeping in mind. Because at the end of the day, insurance is not a volume game. It's actually a capital allocation game. So, a real-world thinking here on this. This is also why you will see big insurers walking away from business, reducing exposure to certain lines, or slowing down on growth intentionally. It's not because they cannot grow, it's actually because they understand the impact on capital and in their ROEs. And to conclude this subject, I would say growth feels really good. It does. Nobody would, say otherwise. But disciplined capital allocation creates value. In the next video, we will go deeper into how insurers decide where to allocate capital between underwriting and investments. That's critical for you to understand. If you want to understand how insurance really works at a strategic level, follow the series. Thank you so much for supporting this channel. Give it a thumbs up if you liked it, and share the content as much as you can. Consider subscribing, and I'll see you in the next video. Thank you. See you. Bye.